there. I am here with Troy Thomas from Paramount Tax and Accounting, and I bring Troy in for some of the heavy hitter questions. I have my way of explaining it, but I think coming from an accountant, you have almost a different direction to pull it from. And so the question that we're asking today is, okay, Lisa, I'm currently a corporate executive. I'm pulling in maybe 200, 300,000 a year. Or maybe I was laid off and that's kind of what I'm looking at as salary and what I want to get from this business, that type of thing. And you have a great way, Troy, I think, of explaining kind of the differences of that bottom line when it's coming from a W-2 versus it's coming from your own business. So thank you, Troy. That was a long introduction.
Thank you, Lisa. It's a question that's asked often by individuals that are looking at transitioning from a corporate America type job or W-2 job to business ownership. The thing with owning a business is that it provides you with a higher level of tax deductions in how you structure your business, how you operate the business. The government sets up advantages for owning a business because we want to create jobs. We want to create new businesses in the country. So we provide those owners a tax benefit for doing so. Oftentimes, what we see is an individual will look at their W-2 pay stub, whether the current or past, and say, this is how I generate my standard of living, and I need to match this or exceed it. They'll look at a item 19, an FTD, and go, how do I get there? How do I move from his to this in a time frame that makes sense to me? Being able to look at their actual income versus expenses that they have in their day-to-day life that they can't take advantage of as a W-2 employee, but can as an owner of a business. So most businesses that you buy, and you're going to start off as a new location, for the franchise, you're going to need a vehicle. Well, that vehicle can be immediately, in most cases, put into the business. Okay, so that vehicle has zero write-off to you as a W-2 employee in most cases, right? So now we can depreciate that vehicle as an asset within the business, and that becomes real dollars to you, right? Because now you're able to deduct that as an expense. You've got many other expenses in your day-to-day life, your cell phones, your insurance, other things like that, which again give you no tax advantage, but now provide you with real deductions that allow you again to generate more income that way. So being able to understand those is very important.
Right. So Troy is our accountant. And he helped us with this. And I mean, y'all know my office, right? This isn't virtual. Those are my grandpa's golf clubs there. And he's like, Lisa, you work from home and you got a decent office. What are you doing? so thank you for that. But I think that that's important because I think people do look at that W-2 and they don't remember the fact that you're using that take-home money is it. Like now you've got to pay your phone and your vehicle and your whatever. And there's a lot probably in there that you're going to be able now, and you're going to need it. It's not, you're being legal. It's not shady. I work from home. This is my office. If I don't have this, I'm in trouble.
Well, if you're working for somebody else, they're taking those deductions.
Right.
So that's the reason for you to take them, and you start your own business, and those become deductions for you, which offset the need for income. So you really don't need as much income in owning your own business as you do in a W-2 job. That's the bottom line. There are different gauges out there depending on lifestyles, but generally in most cases, it's 60 to 70% of what you made as a W-2. That's all you really need to earn in your ownership, or owning your own small business. Some are as low as 50, depending on, again, this scale and your needs. So I would advise anybody looking at it to talk to a CPA, to give me a call or whatever, but you can take a look at it and say, this is what I make and these are my general expenses, and if I buy this business, this franchise, what would that mean to me? How much would I need to generate out of this? And the other part of it is ownership, or owning your own small business. Some are as low as 50, depending on, again, this scale and your needs. So I would advise anybody looking at it to talk to a CPA, to give me a call or whatever, but you can take a look at it and say, this is what I make and these are my general expenses, and if I buy this business, this franchise, what would that mean to me? How much would I need to generate out of this? And the other part of it is there's two big pieces that you're generating. Number one is you're generating cash flow. So that's what you get to take home and eat off of. Okay. But the
Right.
other thing in buying a business is you're generating an asset in the business itself.
Amen.
And
Thank you.
and that asset is a very important part because that's your exit strategy down the road. Whether you're building that asset to hand off to your children, or whether you're building it to sell, whether you're building it to flip. There are a lot of people that get involved in franchises that love startups. They want to start it, build it, flip it, and go start something else.
Right.
A lot of them have ADD and they like to just quit going and then do something else. Not saying so, but there are a lot of people that don't value the asset that they're building in their decision to move forward. They don't look at that. And again, as a franchise, one of the big values, I would argue, outside of the initial training and support that you get out of the franchisor, one of the biggest assets is the valuation of your business when you want to sell it. Because one of the big concerns is if I'm buying somebody's business, and I've bought several businesses over my lifespan. When I buy them, I look at the owner and I go, okay, so Bob, buying your business from you, okay, how long are you going to stick around? Because when I stroke that check to you, are you getting out the door as fast as you can, or are you going to stick around and help me transition this business and take it over? And with a franchise, that concern isn't there. That need for Bob is only for a very limited amount of time because the franchise is going to be there to support me. The franchise is relying on that money. That franchise is needing that location to continue on at least at the same level it is as they always want it to build more, which you want to do as well. So you're building an asset that is more valuable in its transition, but also is arguably the biggest asset you'll have in your lifespan and anything you have on your personal books.
Mic drop. That's pretty much going to go on my homepage. So thanks, Troy.
No problem.
You said it better than I can, but we're going to say that a million times. We're going to shout it from the rooftops. You can't just look at the now when you're looking at a business acquisition, considering business ownership. You have to look into the future, into the horizon, and what does the exit look like? And that's kind of what you're comparing. So thank you so
Absolutely.
much. I really appreciate it.